You're watching a replay from the 49th Annual Gabelli Automotive Symposium, recorded live via Zoom in Las Vegas. This presentation is shared as originally broadcast. Minor technical interruptions may be present due to the live recording format. Thank you for tuning in.
It's my pleasure to introduce Standard Motor Products, who for over a century now has served the automotive aftermarket as a manufacturer and distributor of replacement parts. They serve the traditional auto aftermarket through their vehicle control and temperature control segments, as well as some of the industrial end markets through their engineered solution segment, as well as they recently completed the acquisition Nissan's Automotive for $390 million back in November 2024, which has performed well and been a great business for them. The company has about 22 million shares. It's around $38 for about 850 million market cap and about 500 million of net debt. Here to introduce Eric Sills, the CEO, President, CEO, and Chairman, and then Nathan Iles, CFO.
Well, good morning, everyone, and it's good to be here at the 49th. Big one next year, which we'll certainly be at. Anyway, just gonna start with just a couple quick introductory slides just to get everybody kind of somewhat up to speed on who we are, but then really it's much more interesting, I think, to get into the Q&A. So I'm gonna go pretty quickly through this and figure out which button to push. Obvious than usual. There we go. All right. I guess this was already kind of part of the introduction on a little bit who we are, but again, who are we? You see we're in three of the business segments that was already described. About 2/3 of what we do is our core business, the North American aftermarket. But you do have these other two segments as well, and I'll talk about all three in the next slide. We are a 106-year-old company, very proud of that, and we are global. You see we got about 6,200 people around the globe, and we've really been kind of expanding that footprint, especially more recently with the recent acquisition. So let me just jump in to a little bit more about the different segments. All right, so North American aftermarket. Again, this is where we started. This is up until 15 years ago. This was north of 90% of what we did. And so how do we go to market here? We're really a full line, full service provider, professional grade products, heavily focused on the DIFM space. So it's all the parts for all the cars and a lot of value added services to help all of our trading partners really sell downstream to the professional repair shops. Because of our strategy and the breadth of what we do, it's really allowed us to become the primary supplier in our categories to pretty much everybody out there. So it's very substantial market share and very strong relationships with the trading partners, and again, down through the professional repair shops who really all know our brands, request our brands, and it's been a very successful model. Moving over to the far right, engineered solutions. This is our non-aftermarket part of our business. You can see it's a relatively small percent, about 17% of what we do. The new vehicle and equipment production. So it is OEM. There is a piece of it that is light vehicle, but that's the smallest piece. We really focus on different end markets such as commercial vehicles, farm and industrial, power sports, and so on. Really kind of the more niche end markets that are much more suited to our types of products and our types of manufacturing. And then the middle piece, as was mentioned, this is the newest part of SMP, the European aftermarket. This was an acquisition that we did closed in November, exactly a year ago now. And it is a business that is really very similar. It's called Nissan's Automotive, very similar to what we do here in North American aftermarket, similar product types, very similar go-to-market strategy of being, full line, professional grade branded product. So it's really been just a wonderful fit where we have a tremendous ability to help each other while we really don't compete with each other because we're operating on separate sides of the ocean. So it's been a fantastic addition to us. We've really spent the last year getting involved in developing what those synergies are, looking at integration opportunities where it makes sense. And we really think we're just getting started. It's probably a little small to read on it, but it basically is saying what I just said. It's two companies with very similar go-to-market strategies that are really able to help each other, both from the cost side, because we are in similar product categories. We're able to look at consolidating our purchasing spend. We are able to insource where one of us manufactures and the other doesn't, and really kind of leverage that combination. So heavily involved in the cost reduction side of it. But frankly, probably the more exciting part is how do we think about growth? And while we are in different product, we're in similar product categories, we have different strengths. So it's allowing us to build out each other's portfolios on both sides of the ocean, where we can help launch new categories for them. They can help us launch new categories here. And this is an area where we are just getting started, but we really see that the sky's the limit. So again, I don't want to talk too much. I'm sure that there's potentially some questions about that, and I could be more targeted in how I address it. But we're 1 year in. It's been just a fantastic addition to us. Just lastly on manufacturing, we are a basic manufacturer. Not everybody in North American aftermarket is. A lot of people are really good at sourcing, but we are committed to being a basic manufacturer. The key takeaway on this slide is that we're very diversified in the geographies, but even more specifically, we're heavily indexed towards North America. About half of what we sell. So it's allowed us to take advantage of the free trade agreement. And obviously the hot topic these days is tariff impact. It's really allowed the majority of what we do here to not be impacted the way a lot of other players are. We do have some exposure to China, but that's only about a quarter of what we do. And the last quarter is in other less tariffed regions. We're a large manufacturing base in Eastern Poland. So it's coming in a lower tariff. So it's allowed really the tariffs to be a manageable thing for us. But more importantly, we believe a competitive advantage when we think about how others are much more exposed than we find ourselves. And with that, I'm turning it over to Nathan. He's got a couple of remarks, and then we'll open it up for questions.
All right, thanks, Eric. Good morning, everyone. So we released our third quarter and 9-month results on Friday. So the book is on our website and more information there, but just want to hit a few things quickly. So the first set of columns is 3 months for Q3 ended this year, last year, and then the 9 months are on the right. And what I point out is on the top line sales growth for both periods on the page, we've grown about 25%. A lot of that is certainly helped by the Nissens acquisition, but the legacy business is also up about 4% for both the quarter and the full year. So continue to see very nice organic growth as well. Gross margins are up year over year. Some of that simply has to do with mix of business because Nissens is a little bit different business profile, being more of a distributor. They have more higher margin, but also some higher operating expenses. But it's nice to see really higher gross margins and then gross profit metrics that are increasing, operating profits that are increasing as well. So very good performance for the quarter and year so far. Just rolling it down to finish it out, adjusted EBIT up 170 basis points for the 9 months and diluted EPS up 28%. So Nissens has been great, but the underlying business also continues to perform very, very well. And last, just touch on capital allocations. I know some probably have questions further than this, but we continue to have pretty steady spend on CapEx, supporting the growth in the business year over year. We do have a little bit additional this year as we finish standing up a new warehouse in Shawnee, Kansas, and that is coming to completion soon. We continue to have a dividend, support that program with our board support. It's been very steady over the last 15, 20 years. And then as we think about other uses of cash, really focused on debt pay down this year as we get through the Nissens acquisition and integration. And once we get that down to a little bit lower level, we're looking more at M&A and share repurchases again. So with that, I'll wrap it up and hand it over to Q&A.
Thanks for the overview. It's great. Just start off, can you talk about your process and philosophy regarding your SKU offerings and how you guys kind of give that whole full line coverage on certain parts?
Sure, and that is really a key part of our strategy is to have that full line coverage, which we believe is probably the single biggest moat that we have against the competition. We have somewhere around 80,000 SKUs in our offering, and really, as more of the businesses, our distributors, our customers need a supplier that's going to have all the parts. It's easy to have the hot lick stuff. They need somebody who has parts for more obscure vehicles, older vehicles, late model coverage, and importantly, staying on top of newer technologies. And so we very much believe that full line approach is probably the most significant competitive advantage that we have. It's what's allowed us to be the primary supplier at all of the distributors, because it's hard to do what we do, and there's really nobody who can do that.
So recently, I had the pleasure of visiting you guys' headquarters out in New York. Can you just talk about some of the R&D and kind of innovation that takes place at the headquarters in this?
Sure, and it was good to have you there. It was yeah, so we do have a large engineering department in New York. That's where our legacy is in New York. Some would say, why are you industrial in New York? But it's been a great place to be. Anyway, so yeah, so we have a large engineering department there. But we have 13 design centers around the world. Each are focused on different product types, and it's a significant part of the investment because it is about maintaining our competitive edge of being a basic manufacturer, bringing in-house new technologies, but also to make sure that we're able to stay on top of the quality, because we go to market as a professional grade brand. And so we need to be very proud of what's in our box. It's the quickest way to spoil your reputation is to start making compromises. So it's a significant part of what we do.
So given that we have some of the large distributors here presenting today, can you just talk about how you help them kind of make that delivery of parts within the 30-minute time frame, and kind of how the new distribution center in Shawnee can help with that?
Yes. So this is kind of the second piece after having that coverage. First, you have to have the coverage, but then it's really about being able to have that availability of the product in market. Because it is an arms race to be able to get that professional installer. And you're right, that the expectation is 30 minutes or less. And whoever gets the part there first makes the sale. And so we need to, first of all, work very closely with all of our trading partners on category management, on tailoring inventories specific to geographies so that they have the best forward deployed inventory. But then it also means that we need to have very strong upstream supply chain capabilities to be able to get product to the need quickly, whether it's emergency orders coming out of our distribution centers where we do thousands of them a day. You mentioned Shawnee. That's I guess we didn't make. I guess you spoke briefly about it in the financials, but that was a big investment we've made over these last couple of years in a new distribution center in Northeast Kansas, which was really more about capacity expansion. We were pretty much out of space as we've grown our business, so it added a couple 100,000 additional square feet. But it allows us, again, as kind of you're asking, to be a better supplier to the customers who need quick delivery, the ability to support their footprint growth. And so it's been a big investment. It's live now. We're continuing to fill it over the balance of this year and into the beginning of next year. But it's been an exciting big investment for us.
We had a question over there.
A question about your competitive advantage with your geographic setup. How is that materializing from, with tariffs in Mexico? How are you seeing yourselves next year in year 2 of tariffs from a market share perspective?
Good morning, Scott. We do believe that, first of all, it's a big topic in every customer discussion that we have. And that's not new. We've been talking about the advantages of our footprint for a decade. It goes back to the first round of tariffs back in 2018, and then the geopolitical issues, supply chain issues coming out of China. So we feel that it has always resonated with the suppliers. Now in this more recent, real tariff push, the conversations have gotten even heightened where we say, yeah, we're passing through some of these costs, but we believe that we have a lot less that we need to pass through. And critically, it's not just about cost, but we think that we provide more stability going into the future. Does it parlay into market share? It opens the conversations. Nothing's to speak of specifically, but we believe not only has it allowed us to get deeper penetration with our customers, more importantly, it's allowed them to expand their market share downstream because it's given them the ability to be able to be priced effectively.
Staying on tariffs, can you just talk about to what extent you guys are able to pass through price in order to maintain gross profit dollar?
Yes, so our first intent is to control the cost. And so we have been able to mitigate in different ways, working with our suppliers to move production out of China into lower tariffed areas. But certainly the biggest lever is passing it through. And so we have a program with our customers that is very transparent and very fair, that we're not looking to make a profit on the tariffs. We're just looking to pass them through at cost. And in a way that allows them to move up or down. And so that approach, coupled with the fact that it hasn't required us to go with very big numbers to them, has been well received by the customers and accepted. And we plan to continue to use that playbook. So, for example, now it's announced that the IEEPA tariffs will likely go down 10%. So now it's a very easy way to work with our customers to say, okay, well, with a timing offset, we will make our adjustments accordingly. In terms of, but since we're passing it through at cost, there is some nominal margin compression. I don't know, Nathan, if you have any insights into what that
The numbers, but we do have margin rate compression, and we kind of saw that start in the second quarter this year, probably continue a little bit of some way through second quarter of next year as we roll through, but we'll start to lap that next year. A nice thing is with the Nissan's business coming in, it's not as big as it would have been otherwise, so nice benefits there.
Yeah, curious on Nissan's here, now that you're a year into it, given your strong market position in the United States, what factors give you confidence that Europe is a market that's worth being in long term?
So it's a great question, because you are hearing from certain public players over there that it's becoming a tough market. But really the devil's in the details. A lot has to do with, and similar here, is what product categories you're in. And so we're seeing softness. We're hearing about softness in Europe, similar to what you're hearing here in the discretionary DIY type products, maintenance items that you can perhaps defer the work a little bit. The product categories that we're in on both sides of the ocean are largely non-discretionary. Cars on the rack, it needs the part. And so what we've seen over in Europe is our product categories are outperforming just because of the nature of the category. But more importantly, and what really drew us to Nissan's is they're gaining share. So when we decided that we thought Europe was an attractive growth opportunity, we knew we needed to find a partner who was strong, growing, fit our business model. And that was certainly the case prior to the acquisition, and over the year that they've been under in our company, we've seen that continue. And so while every market is potentially going to have its cyclicality, aftermarket less than many, they're an outperforming type of a company. And the more we've worked with them, the more we're impressed with how they've been able to do that.
Staying on Nissan, can you just talk about your expectations of synergies and the cross-selling between the North American business and Europe?
Well, cross-selling really comes in two forms. The first, and I alluded to it in my opening remarks, is about broadening each other's portfolios. And so while they are also in thermal management categories and engine management categories, they have very different weighting than we have. And so we are able to fast track to each other new categories. So for example, as they look to expand their engine management type products in Europe, we are very strong in ignition coils. It's the biggest category here in the US. We manufacture them in Poland, so it's Europe for Europe. And so we're in the process of building out an offering that we can launch in the beginning of next year in Europe. And so that's just one example. We have similar ones on this side of the ocean where they're very strong in some heat exchanger categories that are really kind of a gap for us. Could we do that organically? Of course. Do they provide a tremendous accelerator for that? Yes. And so that's where we see it. So that's the first area for growth potential. The other is really just cross-selling, introducing each other to each other's customers. And that too is on both sides of the ocean. 85% of what Nissan's does is in Europe, but they do have a footprint here, and we're able to open doors for them, for our customers here, and they're really focused on the import specialty group, so they're able to help knock on some doors for us. Europe, it's the opposite. So for example, companies like Genuine Parts Company has really been pushing into Europe, and we're a strong supplier for them here, and it allows us to have very effective conversations and nothing specific to report, but it opens doors.
Thanks. So given some of the recent news and developments with First Brands and the factoring supply chain finance programs. Can you just talk about your use of these programs and what you expect to come out of these developments?
Yes, so I can take that one. So we participate in the programs like we have for many years, really at our customers' requests. And I think those familiar with the industry and the retailers know these are kind of their programs set up with their banking partners. They've been in place for a long time now. So what we see, there continue to be steady, stable programs. We're participating in them, and no real difference at this point.
And are these programs as relevant in the European market as they are in North America?
Yeah, so supply chain financing is certainly a thing everywhere in the world, and it's available in Europe. It's not used as widely, and I think some of that just comes down to differences in customers and diversification of Nissan's customers themselves. And so while there is a little bit there from time to time, it's not like it is here in the U.S.
Can you just discuss how an evolving car complexity and benefits your guys' business?
Sure. So, automotive technology has always evolved, right? We're a 100-plus-year-old company. We've always evolved with it. And so as long as we're willing to make investments, it always presents an opportunity. I think what we're seeing now is, perhaps an acceleration of technology change. And we see it, again, as an opportunity more so than a threat. And I think electrification gets a lot of the attention. But what we're really seeing is the car manufacturers are investing significantly in making ICE engines more efficient and effective, and as a result, they're adding new part types, new systems to continue to make conventional powertrains effective. These are all parts of opportunities. They're all very much in our wheelhouse, and so we see that as real growth potential as we broaden our categories. Safety related components. There's proliferation of safety related components on a vehicle, and we're kind of known as the sensor guy, and so our customers expect us to be the ones to bring those sensors to market, and we do. On the temperature control side of things, where it was, the majority of what we do is passenger comfort, air conditioning mostly, some heating. We're now seeing thermal management systems expanding on a vehicle, as it's about battery temperature management, and other systems need to have a proper temperature maintained. So parts proliferation is and you're the type of company that the customers expect to be the ones to bring it, and so that's what we're seeing.
Eric, any change in the comfort levels of debt to EBITDA, particularly in light of the First Brands that you asked before, in terms of the debt covenants on your payables? And right now you've got debt to EBITDA of what?
2.6.
2.6.
Yep.
Yeah, kind of high relative to your standards, assuming the payables and inventory are constant. Anything else? And what are you doing on hedging currency? Anything different?
Yeah, no. So straight answer is we're comfortable where we are. We came into the year about 3.7 times levered, but a lot of that was because we didn't have a full 12 months of Nissan's EBITDA in. So worked our way down to 2.6 times now with almost a full year, and we'll be, I guess to your point, we lived in the world of 0.5 to 1.5, and are targeting 2 by the end of 26. We feel good about the target, and so I think we'll have a lot of room to maneuver once we're down around there, and good with working capital and other levers as well.
Gone from sweet and sour pork to tacos to kielbasa. I'm trying to figure out where you're going to go next in the rest of the world. Thanks.
Well, it is a smorgasbord, and we like it all. Don't forget about the smoked meat up in Canada.
Poutine. As it relates to First Brands, any change in how your financing partners, rating agencies, et cetera, are looking at factoring off balance sheet debt and any potential issues for this as you look forward the next 12, 18 months?
No, we haven't really heard any rumblings with in regard to what I call it the plain vanilla supply chain financing that we've all been participating in for many years. I think we'll see what happens with the First Brands and any discovery that comes out of that, but it's probably a little bit different animal than what we're doing on a day-to-day basis in the industry in general.
With these factoring programs, can you just talk about how the more recent interest rate cuts have helped out the P&L?
Sure. Yeah. So just some high level math we always point out, and the numbers are in the K and Q, but every quarter basis point impacts us by a couple $1 million. So that's what we tend to see move us around a little bit. Obviously, we got swung around a great deal when interest rates went up. Have had a little bit of help this year, and you can see it in the numbers as rates have come down. The key thing to point out, though, is we're on a 360-day SOFR rate with these programs. And so to a certain extent, it's looking forward at what the rates are going to be in a year, and that gets baked into the numbers. So you don't get stepwise changes in those programs.
And can you just quickly talk about the margin differential between Nissan's and the North American business? I think you talked a little bit about how that's more of a distribution business, but can you just expand?
Sure. Yeah, and so a higher gross margin, higher operating expenses. Overall, they have Nissan has higher EBITDA. And really, I think two things to point out there. One is factoring programs we talked about, not as big of a thing in Europe as in the US. So that accounts for some of the differential. And the other piece is kind of, I'll call it a returns culture. So returns is much more of a bigger thing here in the US. Think about just general consumer returns, same concept as in the auto aftermarket. And there's not that same return culture in Europe. So those two things together help the EBITDA come in higher.
Looking at the balance sheet, you still carry the asbestos liability. Maybe just brief the audience on plans slash how what cash in is per year for that.
Sure. Yeah. So we do have an asbestos liability. I guess for context, it relates to a business standard owned for a relatively short period of time from 86 through 98. And I think asbestos wasn't even put on brakes even long before that. So it's something that we continue to manage. We update it in the third quarter of each year with help from our actuaries. So we made that update. From a cash cost perspective, it's been running in the 15 to 20 million range each year. And so it's something that we handle and we manage and have the ability to do so, continue to do so.
Can you just quickly touch on just capital allocation priorities between organic investments, and shareholder return?
Sure. Yeah. So, focused on CapEx and dividends, and, from a CapEx perspective, we'll kind of get back to a more normalized level in 2026 once the new warehouse is behind us. That's probably something in the 30 to 35 million range for CapEx. And then as we get through this period of debt reduction, we'll be looking at M&A opportunities and share repurchases to the extent that M&A isn't out there for us.
I really appreciate you guys coming to the 49th annual Autumn Symposium, and hope to see you back here next year, and maybe I'll see you back in New York as well.
We'll be here.
All right.
Thank you, everybody.
Brian Sponheimer is a portfolio manager and Edward Nakamura is a research analyst at Gabelli Funds. This webcast is a recording from the 49th Annual Automotive Symposium, which occurred on November 3rd and November 4th, 2025, in Las Vegas, Nevada. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of September 30th, 2025, affiliates of GAMCO Investors Incorporated beneficially own 24.44% of Stratec, 10.09% of Rush Enterprises Class B and less than 1% of Class A, 6.44% of Standard Motor Products, 4.39% of Monroe, 3.96% of Dana, 1.68% of AutoNation, 1.17% of Advance Auto Parts and less than 1% of all companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 3554 914 921 5100 fax 914 921 5118 info@gabelli.com.